All right, after finishing the week off pretty nicely last week on Friday, this was not the start to the week that we were looking for today. So a little bit of a turn. It was not a significant move to the downside. Fortunately, it was not we didn't break down, we didn't fall down. So you'll see that's a common theme in a lot of the charts that we look at today. We are not bearish. We haven't turned bearish or broken down into a new intermediate decline, but we've also broken down enough that we're also not bullish anymore. And the promise of bullishness that we had last Friday, we lost that. And I'll show you how and why with some of the patterns on the different charts here today. We'll take a look at some of the biggest mover. Again, that big three-headed monster that we talked about that has plagued risk appetite here for the past so many years reared its ugly heads again today. So we'll take a look at what's really driving, how these different asset classes are moving markets and moving risk appetite in general. We'll take a look at how it's impacting our sector rotation and our breadth indicators, as our breadth has been so strongly bullish, but has shown signs of deterioration. And I'll show you that here with today's move and the move, the sector rotation that we don't necessarily want to see. No matter how much you hear on TV about how great it is, we're getting this broadening trade. It's not necessarily the rotation we want to see, and I'll show you kind of what I'm talking about there. And we'll take a look at a trade idea, which you would think would do well in a more bearish environment, but has been more linked with risk appetite here lately, which hasn't been very normal for that type of stock until like the recent history. And we'll see its breakdown and talk about how to trade it. So let's go ahead and get started. Today is Monday, October 7th, 2024. This is the market outlook from marketscholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down here, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click on this thumbs up icon. It opens up this tab. Scroll down, hit that like button on today's Market Outlook video. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who click on this day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's take a look at the S&P 500 with the market forecast indicators. You can see the intermediate line is continuing lower inside the upper reversal zone. Still bullish, though it's falling there. And you can see the market sentiment line still rising, not in the upper reversal zone yet, but at least it's still rising pretty clearly in bullish levels, there. What happened today with the decline is it actually brought, so remember we have 2 days to get the near-term line from being below 40 to above 80 to produce a bullish near-term low, to subsequently produce a bullish near-term high, and for us to really continue going. That obviously did not happen today. So we were looking for a new bullish high today, and we didn't get that. The near-term line actually declined. It's still at bullish levels. It's still above the 60th percentile. But if we were to falter tomorrow again into the middle of this week, then then now we'd have this would be a bearish near-term peak. The near-term line would have 2 days to get from being above 60 to being below 20 to produce a subsequent bearish low point that we haven't had, again, for a while, since over here when we had this bearish peak followed by this bearish low, and we were on the cusp of another intermediate decline right after this one. So that's, we went from, being pretty bullish. The momentum line was up there. Like, there was good odds that we would get a new bullish high point, to then today's decline kind of changing that around. And you can see very similar patterns on the NASDAQ 100. The near-term line still in the bullish territory, but again, potentially forming, with the momentum line already oversold, potentially forming a bearish peak here. Now, if you look at the S&P 500, the near-term line, the momentum line did not drop to extreme lows. Technically, by definition, this is a bullish intermediate confirmation signal. An oversold momentum line combined with a bullish, dark green shading and a green line. That combination it basically is a buy the dip signal, similar to what we had over here, where we had that signal for a few days, and then we bounced up on this near-term rally, kind of weak near-term rally, but we bounced up off of that. So technically, this would be a bullish sign. Again, the idea though that we did not already have that. See, the issue is like the near-term line was already in bearish levels, and so we should already have been bouncing off of this. Now the near-term line is actually still in bullish levels, so it's not necessarily the best pattern here. So you can see over here, even when we got the last time the momentum line was down here, the near-term line was at bearish level, so it was a good opportunity to bounce off of that. That's not necessarily the case here. In fact, it's, again, like I said, setting up for a potential bearish near-term peak. If you look at the Dow Jones, again, the same thing. We were looking very good here. Again, we had gotten above 40 a long time ago. We had gotten below 60, never did get a bearish, but we're not really producing a bullish move either. Even with the big jump in the momentum line on Friday. Now, it's not oversold today, so that's a good sign. The intermediate line still in the reversal zone, so that's a good sign. Market sentiment still rising. We're still above it. Those are all good signs. So this hasn't changed anything yet from that perspective, though you can see that long lower shadow still looking pretty ominous there as a reversal pattern. If you look at the Russell 2000, remember we talked about that long upper shadow way over here, and we flirted with the high of that, which acts as a resistance the next day, and of course we've been forming bull tags since. It's been on the, in fact, the intermediate line now is out of the reversal zone. The near-term line did cross back up above it. So now these crossovers matter because the intermediate line is between the reversal zones. So when you get a near-term cross above it, that's a good sign, right? Kind of like this, you get a good move to the upside. Same thing over here, you get a good move to the upside. Now it's only barely above it, so it needs to really, like, it can't be like one of these things where it's only like barely above it, and then we end up forming a bearish near-term peak and we roll right back down, which, again, considering the momentum line and where it's at, this appears to be the more likely scenario, more so than some of these bullish crossovers that we had earlier. So again, we really need to build off of that. It would have been more ideal if the momentum line was up above 80, because then we can get, remember, we're supposed to get from being below 40 to above 80 in 2 periods. And we didn't get there. Everything looked good yesterday. We didn't get there today. It went up, but didn't get above 80, and the momentum line's already down. Thankfully not too oversold, but it's already down. So it makes the likelihood of us forming a bullish near-term peak lower. Not 0%, not even like 10%, but a low probability of kind of in that 30% range there. Now let's take a look at the weekly chart here. That we'd like to look at. Again, starting off a new week today. Remember we talked about the lower close makes us susceptible to a transition candle this week. And as of right now, 1 day in, that's what we're getting, a transition candle this week, which is not a problem if we have a bearish, if we don't have a big bearish candle here. So we're only 1 day into this, so we'll see how we end up finishing. My guess would be if we end up with a big bearish candle, we probably won't have a transition candle. It might end up being more of a bearish reversal, kind of something like this, where we have a little bit of a long upper shadow and then we roll over. So something actually very similar to this type of candle, or even this type of candle right here. So assuming we get a bearish week this week, again, we don't have to. All right, if you take a look at the Russell 2000, remember the Russell 2000 did form a transition candle last week and has formed a bearish candle now, but it's really small. It's still not necessarily an issue that we have to worry about yet. Looking at the 3 green arrow charts, we do not have 3 red arrows anywhere, not even on the Russell. We did briefly have 3 red arrows in the Russell. We got back to green on the MACD. We're still above it for now. So otherwise we'd have 3 reds again. So we're still okay there. And we have 2 reds everywhere else. The histogram is red, which means that it's getting bigger to the downside. But still it doesn't look like we're in the free fall here, nor in a threat to produce a 3 red arrow signal yet. Which, remember, at first would be more likely to be a bullish signal than actually a bearish one, kind of like this last 3 red arrow signal we had over here ended up being a very bullish signal. That was kind of a back in the day when we used to have Investold, we used to teach the 3 green arrow system as a buy signal. The 3 red arrow system was actually the better buy opportunity. when we were on these bullish patterns, bullish trends, excuse me, than the three greens were, considering that, again, you can see by the time you got this pattern, this is where we're at, and by the time we got the three greens, we were already bouncing up pretty strongly there. Let's take a look at some of these other oscillating patterns. We'll take a look at the DMI pattern here, and you can see again we're still both lines below 25. Thankfully, we're not both below 20, which we were a couple days ago. But again, the ADX is below 20. We just don't have a trend going right now on the DMI. If you take a look at the RSI and the CCI, again, they're very neutral levels too, right in the middle of both of the charts. So neither one of them are really, but they're not at bullish levels anymore, but they're not bearish either. Still more at neutral levels there. The Ichimoku cloud, we're still above the cloud. We're still above the blue line. We still have a positive rate of change. We actually still have an intermediate strength trend. So we're just not, the problem is we're just not getting to a mature. Like when it doesn't get to a mature, we're likely to falter, kind of like we saw over here, and we'd be likely to falter again. So that's a problem. We are below the green line, not below the blue, but we're at least below that 9-day, the median, the middle of the 9-day range. So again, not bullish, but not bearish either. So kind of more on that neutral stance. And then looking at the Bollinger Bands, and the Keltner channels. Hit the wrong one there. Let's try that again. Looking at the Bollinger Bands and the Keltner channels, you can see the bandwidth is falling pretty rapidly. The bands, in fact, are really close to crossing back inside the Keltner channels like we had over here. And then you can see we're not in the upper quartile anymore. We're still in the upper half, so we're not bearish, but we're also not bullish either. A very common theme here with the move that we're seeing. If you take a look at today's intraday move, obviously we did not get a new 4-week high point. I talked about by the end of the week, the 4-week low is going to be way up here. So this is today, this would be tomorrow, this would be Wednesday, Thursday, and then Friday. So this is where the 4-week low, unless we get a new one between now and Friday, this is where the 4-week low point will be by next Friday. So you can see, and shoot, by Wednesday it's going to be here, and then by Thursday it's going to be all the way up here. So you see how close we are to not only forming a new 4-week high point, which is not very far away, but we're also pretty close to forming a new 4-week low point by the end of the week. So we are very susceptible to this bearish crossover where we hit 100 on the negative line, and then we have to wait for the green, which is this high tide, to get all the way to zero. Obviously today it's a lower high and a lower low, still inside of last week's range at least, but we did close below yesterday's low, barely, but we closed below yesterday's low point there. The Qs, you can see kind of similar pattern there. Again, we are susceptible with the green line below 70. We're susceptible to the bearish crossover, and as I mentioned, today, tomorrow, Wednesday, Thursday, and Friday. This is where the low 4-week low will be on Friday. Very, very top heavy, very susceptible to a break below. If we break below last week's low, we're going to be very susceptible to creating this new this new bearish crossover pattern here by the end of the week. Obviously, the range today was relatively low. You can see it was barely below. It was below the average, but barely. And again, the volume at 49 million shares was not that low. The volume has been declining. You can see 49 is just a little bit below the average. The range has really been declining. Again, 1% would be below that 5.6 level. So we're getting close to the ATR getting below the 1% mark, and that's really kind of what we need to see. So we're not going to be, if we're going to get a big bounce, to the upside, it's not going to be a big bounce. We don't want it to be a big bounce. Maybe one day, and then that's it. And then we need this range. We need it to be slow and boring and grinding, because once you get below 1%, we can be bullish for a long time. As you can see, that's the key, is to get back below 1% and get the volume back to these low levels here. Let's take a look at the VIX. That was our concern, right? Going into the weekend, the VVIX was high. The VVIX now is really high. So we are very concerned, right? The VIX itself is above 20. It's above 100% relative to VXV. So if you take a look at the chart here, we're right there, right at 100. Right at 100. The VIX is at 2264, and the VIX 3M is at 2259. So we are a little bit above 100 right now on there. So that's that again, that's a pattern we never did get in 2022. Remember, we never closed above 100%. If we did, it was like very, very brief in 2022 during that entire correction. We just didn't get there, and we finally have started to get there during some of the corrections that we've had here lately. So that's a pretty significant deal, and you can see the 2-line version, the VIX, is well above all these moving averages now. Well above its, the 8 and 17 day now are above the 30. I mean, we are clearly in a bullish move to the upside on volatility. And with the VVIX being at 122, we are susceptible to a strong move up to, we're susceptible now to a bigger move on the VIX to the upside. Again, like we were in early August there. So very susceptible to that type of move this week. Obviously would coincide with that bearish crossover we talked about, and potentially the beginning, as we have been in this divergent stage where the MACD has been below its moving average, but we're still above the 17-day. Obviously, we most likely would be clearing the 17 and the 30 in that situation, in that scenario, as well as the point of the value area. Would be starting to close back below the value area there. So that is the type of move that the odds are increasing for, according to a lot of these charts. We very well could get this type of move right here, like we're seeing on my cursor, where we break down, and potentially, or even this type of move where we break down, we start to start a intermediate decline by this week with how things are setting up right now. All right, let's talk about what's driving this price action today. As you can see, real estate and gold are starting to move lower. And interestingly enough, emerging markets continuing their very strong run that they've had for the past few weeks. Let's take a look at just today alone. You can see it out of the context of the 3-month move, and just look at it just on a 1-day period alone. Again, you can see the strong move in emerging markets, and a lot of that has to do with commodities. Very strong move today. Yields were up again today, and the dollar was up. Not up very much on an absolute basis, but obviously up against all these other asset classes. So including gold. So that's, again, that's your 3-headed monster. It hasn't impacted emerging markets. They continue to do well thanks to China. And there's a little bit of a rally here late in the session, so that's a very nice move here at the end. But still, that's our 3-headed monster that we just do not like to see. If we take a look at the 10-year yield, you can see it's continuing to fill in that gap between the 50 and 200-day moving averages, getting up over 4%. MACD and stochastics, very, very bullish levels. That's on the daily chart. If you look at the weekly version, now that we're getting a new weekly chart, again, we are above the 17-week. The MACD is above its moving average. We barely got above it last. Both of these last week. We're continuing today. We're already above the 200-week and looking to make them run towards that 50 and 30-week moving averages there. If we take a look at some of these other asset classes like commodities, remember that's a big mover today. It had been so beaten up going into those rate cuts. A week before the rate cuts is when it bottomed out here, right around 21. Look at that move since. The rate cuts occurred actually right here on the 18th. It was down on that day, but it was up going into the rate cuts, and it's been really up coming out of the rate cuts. Very, very strong MACD there. Obviously the strongest in the past year. Not the strongest in the past 5 years. We had that run where we broke above the 200-day. We continued higher a little bit, and we had a good run over here, especially here when we peaked there in 2022 when inflation took off. But again, it's kind of reminiscent of the periods of time where inflation started to take off, and the issue is that we are already relatively high. See, inflation started to take off back here, and crude oil was only in the 40s, right? In the 50s. We're already in the 70s, and we're flirting with getting back above the 200-day moving average for crude oil, which is where the point of control is, right below $80 a barrel, and moving up pretty high. Very strong move. A lot of bearish breakout patterns across all these different charts, different oscillators that we like to look at. Here's what it looks like on its market forecast chart. Once I get that up here, you can see the market forecast chart here. Dark green shading, the green line. We got the bear tag. We've clearly built on that bear tag. We're up in the 100th percentile. This is the highest above the 30-day moving average we've been all year long. So a very strong move. The intermediate line, and considering that we're the intermediate line hasn't even gotten in the reversal zone yet. It's in bullish territory. The market sentiment line's really low. The near-term line is in bullish. I mean, this looks like, it doesn't mean that we'll go up tomorrow. We're guaranteed to go up tomorrow. But it looks like the trend is clearly to the upside right now. As I mentioned, same thing with the yields, and of course the same thing with the dollar. Dark green, and after being very bearish, dark green shading in the green line, the intermediate line's headed up into that reversal zone. Market sentiment line's been so low, it's starting to turn up here. And again, it's not necessarily the best sign for the markets when the dollar starts to rise. You can look at that very strong bearish short-term sentiment, as we've now clearly made it into a bullish move. So there's a good chance that intermediate line is going to start to make a run, as we haven't had a strong short-term sentiment like this in a while. So clearly a big move, and that's having an impact on all these asset classes. And emerging markets continues to make their big move. It's one of the sectors we've been overweighted in for a while here in our portfolio management class. And you can see here's the weekly chart for emerging markets. And it's been relatively bullish since that October low of 2022. Just hasn't been as bullish as the rest of the market, but you can see the clear move to the upside. Let's take a look at some of the breadth indicators that we always like to look at to see just the strength or weakness of this move. The new highs is actually it's actually still a pretty decent level, 130. I mean, that's not 166, but it's 130 is down here. It's still below the average, which is not a good sign, but at least it's not like extremely low. The new low still has not picked up yet. It's above the average, but it's only at 28. That's what the chart's showing us. It's probably somewhere similar. Yeah, 33 there. So that's not too bad, right? That's actually a pretty nice level. So again, no worries about a Hindenburg Omen right now. We're doing just fine there. What's the concerning part is this. I mean, that's a pretty significant breakdown again here on the number of stocks above their 50-day moving average. You can see we broke below the average here, but this is the furthest below the average since that little decline. I mean, that's a pretty clear breakdown. The number of stocks below their 200-day moving average have also clearly broke below its average, which means this ratio is clearly above 1 and above its average 2 now. Those are all bearish signs, not the best sign whatsoever. The skew drop, that's a good drop, but again, that typically means when the skew is dropping after having been above 160 this entire time, when the skew is dropping, it typically means now that we're on a decline, that we're on a declining move. The actual average of the skew is so high, and obviously we're breaking down on that. The ratio chart of the Qs relative to IWM is down today. It's not breaking down hard. But it is down today. Again, that's not necessarily the best case scenario. We don't really want a breakdown in that. Same thing with ratios like XLY versus XLP. You can see still pretty darn bullish, but you can see we're on a convergence pattern here. So things we're kind of losing the strong momentum we have in a lot of these ratios that we look at that kind of measure risk appetite. You can kind of see the same thing here. We're kind of peaking. And we're already below the 200-day moving average on that anyway, but we're kind of peaking again on another ratio. And of course, the key sector we watch to see how it's doing is this technology sector. And you can see technology is moving. It's still in the leading category, and so is communication services. This discretionary is moving down to the left, not necessarily the best sign there. These other sectors, including energy, is moving up to the right. That's not necessarily what we want to see either. At least we're still above the 8-day moving average on XLK. We're still above the 50-day average here. Like I said, we're still in the leading category. But this is the bigger concern, is energy, which is typically negatively correlated. Like when it's outperforming the market, it is negatively correlated with the markets. The ratio chart is. So it's really been outperforming. You can see the big change in direction above the 50-day moving average. We're moving into the leading category for the first time. Again, another sign that we're shifting away from what we really want to see leading the way higher into areas of the market where we don't want to see leading the way higher. And that would, of course, include utilities and energy, and then, of course, some of these other safety trades, staples, real estate, healthcare, which are all in the lagging now, but they're all in the leading category on the long-term chart. Even if they're losing momentum, they're all in the leading category here, and they're starting. It looks like they're starting to cycle higher now, back up to the upside here. So if I were to look at, like for an example, XLP, which is a consumer sector, has been underperforming. It's been below its averages and underperforming here, but it's due to rotate to the upside, and that's on the daily chart. So if you look at the weekly version, which is a little bit more bullish, or at least less bearish, I guess would be the better way of saying it. We had been so bearish, and now we're kind of like in this stage right here. It looks like we may be kind of in this stage where, again, we've been so bullish, and even XLP doesn't necessarily go up when the market's dropped. When this rallied, it didn't necessarily go up, but it just held value better than the rest of the market, and that's why you had this nice little outperformance there. And you can see that in today's sector performance just by itself. You look at let's just look at SPY, but let's go to there's our sector performance there. And then let's look at today alone. You can see utilities has been so strong here over the past 3 months or so. Looking at today alone, you can see energy is the only sector that's above zero. Everything else still outpacing pretty well. Technology doing okay, lagging, but outperforming the market. But the other two are not. Like XLK, XLY, XLC, and utilities really is not. And that's actually going to lead us into our trade idea of the day. All right, now let's take a look at our trade idea of the day. We'll take a look at Nextera Energy, NEE. It's a very popular AI energy trade. But breaking down today, you can see a big bull tag here. Intermediate line crossing below its market sentiment line, out of the upper reversal zone. The very bearish short-term sentiment, extreme lows, and the momentum line, the near-term line, dropping into the reversal zone itself. If you take a look at its weekly chart, you can see it's forming a weekly bearish candle, first one that we've had in a while, since the summer, essentially. Coming from a very high PPO, the highest that we've had in the past. In fact, last week it was the highest of the past 3 years. You can see a bearish candle there, PPO falling, a red arrow, meaning a crossing below that 10-week exponential moving average. If you take a look at the three, obviously we have three red arrows since we're getting that bull tag. We crossed below the 17 and the 30-day moving average here at the same time, flirting now with crossing below the 50. MACD and stochastics flirting with coming out of bullish territory for both those indicators there. If we take a look at some of these other oscillators, take a look at the DMI. You can see you got a bearish crossover pattern here. The ADX is already above 25 with the negative crossing above the positive and the negative crossing above 25 with the positive crossing below 20. So pretty bearish pattern, as you can see there on the crossover. Light pink shading up there. If you take a look at some of these other indicators, the RSI and the CCI really dropped down to below minus 200. Big breakdown there. The RSI breaking down to 40, haven't quite crossed in the bearish territory yet, but it's flirting with bearish territory there. If you take a look at the Ichimoku cloud, we're still above the cloud, though the mature bullish trend that we had, which is pretty rare for a utility company. We've had two of them this summer, this year, calendar year. Well, we've lost the bearish trend that we've had. We've broken easily below the blue line, still above the cloud, but we've broken below the blue line. We're flirting, we have a very weak rate of change, 26-day rate of change. And you can see the Bollinger Bands and the Keltner channels. We actually crossed below the lower band. It's a very, very low bandwidth. We crossed below that lower band, and we're actually flirting with crossing below that lower Keltner channel as well. And the bands themselves have moved inside the Keltner channels, hence the red dots. But we're losing momentum and looking like we're going to shift that momentum from bullish to bearish through these red dots with a potential breakdown in the negative direction. So what I decided to do here on this trade was to do a long put vertical spread. You can see we already did it. Put this on during the Market Outlook live video today. Selling the low 20 delta, so pretty aggressive. Buying the one strike away. Position sizing for the typical $500 risk that we typically take on these directional trades. It's a pretty aggressive trade. So it's over 3-to-1 reward to risk ratio, but I have some flexibility for timing in case it doesn't work out. Doesn't drop immediately, and that's our trade for today. So All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.